All right, welcome everybody. So we are back to our macro discussion. Great day, I would say. Means as we were discussing at the start of the call, we have closed above all-time highs, made a new high, closing high today. Same thing has been happening for Nasdaq for a couple of days. So we have literally in the top of the market right now. And I think mostly which we have been talking about. Let me we can quickly start sharing the charts and so on. But basic idea is we have seen that play out, which we have been discussing in this call for last 2 months, or maybe 3 months, we can say, since April, when we said that worst is behind us and this is the time, where once you pull out the leverage from the market, once you have seen that kind of drop, and if you recover, usually the confidence level is much higher. So that's what we are seeing playing out right now. And let's get going on the charts as such. Let me quickly share the screen. And so one thing which we have seen in terms of where we are on the SPX, as we just said, we just crossed all-time high. Now, the question which everybody is asking is it sustainable? Is it something which we can uh, make new highs? I would say that is what the charts are saying, that yes, because usually when you break out, so either you face resistance at all-time high and you are not able to breach it, or you break out. So technically, now it looks like a pretty much very, very good kind of probability that we will keep making new highs. And one example I can show is last time, even though it was a deeper correction, the only thing missing in this rally is the time correction. We had almost similar level drops as we saw in 2022 when and then when we broke out. If you see how usually all-time high breakouts work, we don't have to go too far out. If you see from start of 2024, when we actually broke out, it was a very steep up move and we gained quite a bit. And interestingly, as I was pointing out for since April, when in the whole meltdown, we took support at exactly that breakout point, which actually confirmed it to be a long-term support. So if you forget about the news cycle, if you forget about everything else, right now we are basically looking like that we did a very nice correction, which was pretty deep, of like 22% on SPX, 27% or 26% on Nasdaq. I don't know, I have exact numbers in front of me, but you will see that it's a very similar chart where we had previously broken out uh, in early 2024. And in fact, Nasdaq had even bigger drop and it's performing even better. So this is, I think, a typical technical analysis where you're seeing the breakouts is even much better on Nasdaq because the correction was deeper. We had much more flushing of leverage in all these big names. And that is exactly what is playing out right now. So let us now talk about, what is driving it. What is driving it is very simple, that we had this many, I would say, decade defining events. Like if we are talking about a big war erupting and getting solved in Iran, we had pretty big discussion around, what is going to be the tax bill, whether it can pass or not. And I think it was right now people are very optimistic that the tax bill is moving forward, even with some compromises. The basic idea is that the Trump tax cuts will be implemented for made permanent, which was set to expire this year. All these things are acting like a positive. And what was negative, what really started this drop was the whole panic around tariffs. And as we all know now, even though it's not resolved, the trade deals are not done, we are still expecting that tariffs will not be crazy, like the way we started, like 150%, 160%. And now we are talking about more reasonable tariffs, which are not at all a big issue for markets. Because if you remember, even during the first Trump term, he had added tariffs. Even during the Biden term, we had continuous new tariffs on China and many other countries. Now, other thing which I think there's a lot of discussion in our macro group. There are a lot of people are debating about the impact of whatever tariffs will be done in July, and the inflation risks and so on. I think I always refer to 10-year yield, as you always know. This is our benchmark. Is bond market worried about it? It doesn't look like. Means if you see where the bond market is going, the money is telling us that they are not too worried about inflation. Because if the inflation was a worry, then yields will not be dropping like this. And probably it's also a managed situation, because we did talk about, if you joined our investor day recently in May, I think we did talk about the changes in SLR, which is going to support the yields. The cost of capital will be brought down by creating more demand. That is being executed now, which is either market is front running, or we are already seeing the benefit of that in terms of more demand for treasuries. So either way, I think the pressure is downwards, and maybe we can look at 2 year, which is even more short term, and you will see very similar chart. So you'll see that recently in last few days, there is a very aggressive drop in the 2 year treasury. Now, why 2 year is important? We usually don't talk about it. Let me talk about it today, because the 2 year is mostly telling you much near term expectation of the bond market. And the near term, as you already know, we are talking about 4.25%, which is the current short term rates. If market is giving you 3.74% in 2 years, that means not only we are expecting at least 3.75, but we are actually expecting lower than that in 2 years, because this is an average of next 2 years, what market is paying you. So this is very clear sign that we are heading towards lower rates. And yes, it can change. I'm not suggesting that this is final, but that is what bond market is telling us right now. And while all the S&P and Nasdaq are making new highs, we are seeing some correction in gold, which is expected, because now we are talking about gold is at, kind of, it was a hedge towards like when people were exiting the risk assets, they were buying gold. But the trend is mainly driven by China or Russia kind of countries buying it, or many other sovereign funds, they are buying this in their reserves. So I would say this correction is still pretty much aligned with right now the traders coming out and moving money to the risk assets. We don't think there is any major change, because the breakout which happened around $3,000 mark is still valid. And we are still making, as of now, we have not made any lower low. If you see the lows we made in April, then in May, we are still if we stop here and if we reverse from here, this will probably be still a higher low. So it's we can call it as a minor correction, no change in trend. And of course, Bitcoin, I think we have been talking about it quite a bit. Nothing changed here. There is one concern here, is that even though it did not close below the strong buy zone, we have seen dip below that temporarily in last few days, which is not great, because you made a lower low. And basically, we have established a downtrend now. But on the other hand, we are still within the band of all-time highs in the strong buying zone. So that way, the fast recovery is giving us some hope that this is not a start of a new downtrend. But on the other hand, I think there is definitely, technically, we have some issues here. But on the other hand, as we have discussed before, the Bitcoin will always find support at 200-day moving average, which is a big deal for an asset class which is primarily driven by demand supply and not by any other news. I think these technical supports work way better for these kind of assets. So this is where we are again. So there's a lot of questions I think everybody had about whether it's sustainable. Now, we talked about it technically. Now let's break it down fundamentally at a macro level. So why this is sustainable? Again, I always go back to big picture view. Look at this chart. This is your money supply, global money supply. So as the concerns, as all the macro issues around the war, around the trade war, or whether the real wars between countries, they are kind of dying down. Ultimately, the money finds its way back into risk assets. And this is what is the growth of, since early 2025, you can see we have already been growing M2 money supply at a very fast pace. This is one of the steepest curves after the correction we saw in a few months in 2024. Now, this is usually the reason why we always say the market go up all the time. And if you see why it is accelerating in last few days even faster, this is exactly what we were talking about in our investor day and many other points. This is the SLR ratio change. Now, what is the SLR ratio? Just a quick reminder to you. That is a ratio of how much they can borrow, like they can lend as banks when they are holding treasuries. How much can they lend against it? Now, what you're talking about is they can pump even more money into the system. They can loosen their lending guidelines once this SLR ratio changes. So that is what is happening here, and we are going to see a lot more, pump up in the money supply. And once the money supply goes up, there is no other way, but it has to come into risk assets once market is much more comfortable. So overall, I think all things are pointing to that we will make new highs, technically as well as fundamentally. Now, I know that people have concerns around what changed. Means what changed from, like, we still have a trade war, we still haven't got trade deals done. We still have, the tax bill is not passed, and even that is getting muted. All the expectation of a lot of tax cuts are going away, with only the Trump tax cut sustaining, and like even the salt tax and so on, like all those things, the perks are now under debate. I would say it's there is nothing changed, but you also need to remember, while we are euphoric, we are back to February levels, and we were in a continuous move up for a very long time. We have wasted this much time. So just for as a catch up, right, in terms of money supply going into the risk assets, every month people are putting into their 401ks, into their, all these investments which come in. And one more thing which I think we should talk about is, I think I would say, dollar devaluation. Now, when the indices are measured in dollars, this is what is happening too. Since Trump inauguration, dollar has been continuously going down. And last time we talked about how they are back to November level. Let me just delete this now, because basically what we are now, we are going way below these early levels. Now we are talking about making new lows on dollar. What does it mean? That when dollar is devalued, everything which is measured in dollar, whether it is stock market, whether it is all the risk assets, net, they should go up. If you look at what does it mean, like for example, we are expecting pretty solid earnings from most of the tech players, because there's a big chunk of revenue which comes from outside US. All of them, when measured in dollars, will show a bump up this quarter, because the dollar is continuously going down. So this is the tailwind for earnings. This is a tailwind for risk assets when dollar is getting devalued against other currencies. And this is not even counting. Remember that when we talk about money supply, we are talking about the dollar measured money supply. So one thing is that the net money supply is going up. So that itself is a tailwind. Second thing is we're talking about dollar devaluing. That means all the risk assets, when measured in dollars, are relatively also going to go up in dollars. So this is where I think the macro is playing. So while we can talk about the headline news that, oh wow, the trade war can't come back, or there can be more issues, but this is where the macro picture is suggesting us why we are making new all-time high, and why everything is looking like higher priced. So let's
Raman?
get into the questions, and feel free to comment. Yes, go ahead.
Yeah. So my one question, I think you pointed out something very good, which I had not thought of. So if a company like Apple or multinational gets, let's say, 75% revenue outside of US, and if dollar falls in value by 10% against those currencies, whether it's euro or pound or whatever we have, then without any real increase in earning, it'll look like that their foreign earnings went up by 10%, right? But because
Yes.
then you're going to value P ratio in US dollar back base, then the dollar price will go for the stock by that much percentage, 10% or
That's right.
75%.
I think you can analyze it in multiple ways. One is, of course, the earnings numbers. The second thing is the biggest worry. What was the biggest worry of the market is tariffs. Now, if the net average tariff will be 10%, if the dollar goes down by 10% against other currencies, basically the cost in the foreign currency for the supplier is the same. They're basically able to supply at the same cost. They don't have to change the price. They don't have to give accounts. Dollar, they're already getting more money, because in that currency, in that country, so there are a lot of benefits of dollar going down, for in the context of trade war, in the context of revenues coming from outside, while the which are going to be priced higher, because the prices don't change in those countries. Yes, you're right.
My question where I was leading this was, but that means inflation will also go, like iPhones will be more expensive, right, in US if they're being made outside or parts are coming. Then what does it do to the interest rate cut and stuff if the inflation goes up because
Sure.
of dollar
So
down?
again, there is a debate. There is a debate which is going around on inflation. I would say, uh, uh, when if the whole world runs on dollar, you don't have to increase the price. Like, why would you think? Like, Apple has a great. I think Apple is a very special example because they are the most impacted by tariffs. They're most impacted by dollar devaluation because they have a end product. But if you look at anybody like Google or Facebook or anybody, right? Means everybody where they earn dollar revenues, nothing changes. Even if dollar value goes down, there's nothing changing locally. So if you know, most of the countries have this mismatch in their pricing. Like there's a continuous inflation which is higher than US because everything is measured in dollars. Why it doesn't impact the US is because your base currency is dollar. Your oil is not going up in dollar; it's going down in dollar right now. Even so, how would the inflation go up when everything is priced in dollars while you're devaluing dollar against other currencies? So this is what the fun of being the reserve currency is, that US, what benefits US gets are not the same for what other countries get when they devalue their currency. Because for them, both import and export have the same, it kind of cancels out because everything is priced in dollars. But when dollar devalues, there's a net positive to US because now you can negotiate the prices lower to in the in the other countries. You don't have to pay more because for them they're getting higher price in their own currency. So this is how I think overall what happens is it gets eaten up. It gets eaten up by the suppliers in a way, and the tariffs are going to be get that impact in the sense that you will see the dollar devaluation will help absorb those tariffs, and secondly the revenues will be measured higher. So in general I would say this will be interesting dynamics going forward. All I'm trying to highlight is that dollar devaluation along with money supply going up is a tailwind. Whether it really creates inflation, we will see. But at this moment, the hard commodities, when you look at hard commodities like oil, which are the real, big input into inflation, they are not showing that dollar devaluation is really hurting them. Other only thing which hurt oil prices was Iran war. That got settled very quickly, and now we have oil coming back to low 60s. When you are low 60s, I think is a pretty great place for controlling the inflation.
Thank you.
So, but again, I think it's very complex. I would say discussions. If we start looking the correlation between currencies and how the trade will play out, I don't think we can easily explain it here. But basic idea here is right now why the stock prices are going up, because the value of a company is purely managed by one thing is, as you said, earnings, which is foreign earnings are going to go up, domestic earnings are not impacted right now. We are seeing that the overall spending in the new tax bill is back to the spending levels. So there's a stimulus, as we always say, right? Means whether it was the Inflation Reduction Act of Biden or whether it's a big beautiful bill of Trump, any big bills which are passed in Congress, all of them are ultimately adding to more spending. All of them are adding to more deficits and higher net debt issued and higher net money into the market. So that is what is deflecting into money supply. That is what is uh, keeping a tailwind for this bull run to continue, which is, I think, another question people have is how low can we go? Because we have been in this bull run since if we forget about all these 20%, 25% corrections, can we even have a deeper drawdown in the modern world? That's a question. Like, does it even make sense to have more than 20, 25% correction? Because the tailwind of money supply is so huge that you cannot really have deeper corrections. And now that we had that correction, and this was after 3 years almost, because the last deeper correction was in 2022. And now we did not spend time. I think why a few technical analysts are unhappy is because it was very quick. Because there is one thing called price correction and there is something called time correction. So we did not spend time here, but we have precedence of it. If you go back to COVID, we have very similar situation where we made a low very quickly and we returned back very quickly. So trade war, which was there in 2022, which was we let the inflation run up too high and we had to go and increase the rates very steeply, and that took 6 to 8 months to happen. And because the whole uh, interest rate hike was slow and it took long time, the correction lasted longer. So I would say that is where we are. And also let's look at individual stocks. Like Nvidia made a new high, till 25% below its high, or maybe more. So there is already reflection of which companies are more impacted by tariff which companies have higher risk in this environment. That's already reflected even at all-time high. We are not seeing that market is still acting smart. They are seeing that all the unknowns in terms of trade war are not going to impact Nvidia. They are not going. Means it's hardly, because all those issues are resolved even after the hit to the China. Means that is already defined. The unknowns is gone. Now they cannot export to China. That's a given thing. Given that, market already reacted to it, and it's now behind us. And they still gave us a 70% growth rate year on year after taking a hit on the China earnings in the last quarter. And even their guidance has been not hit. So that gives confidence to market that now I don't have to worry about trade wars. And worst is priced into some of these stocks already in April or the May time frame. So that's where I think the confidence is coming back into the market right now.
Yep. So can I ask
So
one
again, a
question?
reminder that you can have questions in the chat, or you can unmute yourself.
Yeah,
go ahead, please.
So in the beginning, we talked a little bit about crypto, how Trump administration is helping that cause. Could that in the long run undermine dollar as a reserve currency in the world? And then it'll undo whatever we talked about, the value of the debt and how we paid off, etc. If it's in a different.
Sure. So I think, and that's a good question. I think people misunderstand the status of crypto right now. We have talked about how Bitcoin is probably more taking place of gold rather than dollar, because dollar is the strength doesn't come from reserve currency only. It also comes from, as we said, everything is priced in dollars. Like your oil commodities tracked in dollars, or most of the countries when they do bilateral trade, they cannot settle in any other currency other than dollar. Means they can do a barter system style trades where they say, okay, we do it in local currency. And we did take one, I think I remember we had this discussion around how Russia is supplying a lot of oil to India, and India has to then they cannot take the rupee. Like they're doing the deal in rupee, but they cannot really take that rupee back. It's worth nothing when you take rupee back to Russia or anywhere else. So what happens is that ultimately you have to settle in dollars, or you have to start selling your assets. What India is doing is they're saying, okay, go buy my bonds, go buy, get stake into my infrastructure projects like bridges and railways. That's what Russian companies are doing right now. They are coming and taking more and more stake into Indian projects because they cannot take the rupee back. So this is where, this is one example of where there is no way you can replace dollar. So it's not about whether they hold it in reserve currency as a gold or as Bitcoin, or they hold dollars. So the only thing which impacts the dollar when Bitcoin and gold are more popular is the demand for treasuries. Now, they can hold gold, it will still be valued. They will still measure it in how much dollars they have in their reserve currency, even though they might be holding it as gold or Bitcoin. Now, demand for US Treasury is getting definitely lower and lower. That is the biggest concern. And that's where I think Besant is doing all these tricks of SLR changes and so on, so that the domestic demand can be increased, where the foreign demand is reducing. So that's the one impact of gold being popular and Bitcoin being popular. The other part is that with the crypto stablecoin bill becoming a reality, and stablecoins becoming more and more popular, the only big stablecoin is dollar again. So as you move into crypto world, the stable coin, which is where the most of the trading will happen. So people used to question Bitcoin can never be a currency, which is true. It is like gold. We never used gold for exchanging. People don't pay each other in gold. Countries don't pay each other in gold, even though they hold it in their reserve assets. Similarly, stablecoin will act like the actual exchange medium on blockchain world or in crypto world, and Bitcoin will be just a reserve. Now, stable coins is where they are becoming the buyers of US Treasury. So whatever we are losing as other countries holding gold instead of dollar, or probably in future if they start holding Bitcoin instead of dollar. But then what does it mean? Because stable coin are growing, they are already buying Treasury, because if you are if a USD stable coin, you need to back it by US dollars, Treasury assets. And that's what they are doing right now. So I don't think that is a concern at this stage. And definitely at a macro level, rising debt and who will buy US debt is going to be a question forever. But that's why we discussed when we're looking at charts, the US bond market is not worried about it because the yields are not rising anymore. Yields are at 4.25 or 4.30 on 10-year. That means for next 10 years, nobody's worried that the dollar is going anywhere in terms of the demand, even while we have no plan to reduce deficit, even though every bill which is presented is only talking about increasing the debt. So if bond market is happy, trillions of dollars are happy, I think we just have to listen to the market and not speculate what can go wrong. I have a question here in the chat. Do we think the high valuations of PE, which is 21 to 23, can keep going? I would say it is the same thing. Valuations are nothing but relative. So when we have discussed it a few times, let me just repeat it. Why do we look at US 10-year yield? Basically, there's a denominator of any kind of valuation. So PE is an absolute number, but look at it from a money allocation point of view. If your risk-free rate, of which is what we call 10-year treasury rate, is 4.25% or 4.3%, you can justify higher PE for the stock because you have to take higher risk. For getting the same amount of return, you have to go into the equity. If the treasury yields start going up to 5 or 5% or plus, that's when you have to question whether 21, 23, or 25 PEs are good. And then probably you are going to say market should be at lower PE, because why should I go into a risk asset when my risk-free return is higher? So typically, the whole discussion around this is why I wanted to talk about it at the start of the call. As 2-year yields are coming down, that means market is expecting, and 10-year yields are coming down. Basically, markets are expecting lower rates ahead. Lower rates ahead means the denominator of the valuation is always going to keep decreasing, and PEs can expand way more. Now, whether it's sustainable is a question. Means there's always a extreme where we reach, where we have to correct, where earnings are not able to catch up with the expectations. But I don't think that point is today, because right now we are seeing denominator of the valuation coming down. That means the risk-free rates are coming down, yields are coming down. So these have a lot more to expand. What is the top? Means I don't think there's a formula for it. Means you cannot say 21 PE of a S&P 500 versus 25 is the peak or 27 is the peak. Every time it is different. Every time macro conditions are different, and we make tops at different place. It looks like as long as the yields are moving down, market will keep justifying higher PE for now. So that's how valuation works when you look into institutional world in terms of people who have to allocate money when the overall money supply is rising. The risk assets are the only option if you want higher yield. So that's where I think till we don't see bond market signaling that they have had enough, I don't think that's going to be an issue. So overall, I would say yes, we can sustain. And I can also say that there is no rule that PE ratios cannot go higher, because we have already seen it, right? Means if you look at Mag 7 PE versus the rest of S&P 500, the standards are very different. We are looking at way higher PEs, and it's become norm, I think. And again, it's very relative, because I still remember, without taking names of the people, but somebody asked in the WhatsApp group a few days back that, oh, the P ratios are in high 20s and below 30 for tech stocks. Isn't it very low? Means I would say, while you are looking at low 20s as a very high PE number historically, some people are seeing as below 30 as a very attractive PE in the tech world. So, and as S&P 500 is more and more now dominated by tech, why not? Means why are we comparing with historical numbers? Means historically, oil companies led the market cap. Historically, non-tech companies which were not growing at the same pace what tech companies grow. So unfortunately, when analysts show you this data of 20 years, 30 years, they are basically misleading you, because the world is not the same. The tech world is always valued higher. They have shown the growth. They have become multi-trillion-dollar companies from nothing much faster than any other industry ever had. So, and even if you, as we discussed NVIDIA, or when we discussed some of these companies, like go back to NVIDIA last quarter earnings, they had a big hit of inventory loss from China, like almost 3 billion plus. They still grew at a 70-80% annualized rates, which is crazy. Like, means we are talking about AI growth at triple digits right now. If you take out that hit of the China hit, you would be looking at maybe 100% growth rate. And why we should have a 30 PE means we can have 40 PE, 50 PE if these are sustainable. So the question to ask right now is whether we have seen enough of this growth. Market is suggesting not. In fact, even the earnings are suggesting it is not. So we are probably at a place where there is probably a lot more upside left. But of course, the headline news still can impact. So as we have been talking about in the WhatsApp group, there can be a correction because we have run up too fast. On the other hand, we have just gone above February numbers, which are the all-time highs in February. So, and in the from February to June, means earnings are still growing. For the leaders, if you see, means every tech company, nobody has shown any earning slowdown. Forget about reduced earnings. We are not even seeing growth slowdown right now. So if that is the case, then I think we are probably underestimating where market can go. And as I said, we keep watching the denominator, which is the bond yields of the valuation. If the risk-free rates are going down, you have no option but to go to risk assets. So the risk-free rates have to be way higher for stocks to be suppressed, because then you have another option to earn money. But as money supply keeps going up, as risk-free rates keep going down, there's no other option but to come to risk assets. That's what is driving this rally, and that will probably continue. So, but good questions. I think we should always question these things, because as I said, right, means when we talk about macro, it is, maybe we can talk about, like, we are not predicting what will happen tomorrow. We are not predicting what will happen next week, because those are micro moves. So one thing to separate out the noise of day-to-day move, which this you are used to hearing, right? Because that's what most of the news flow is. They mostly focus on last 24 hours, last 48 hours. And that is one thing which you should have ability to separate out. And I would say that's very critical here, because whatever I said today, that yes, this rally can go on, doesn't mean that tomorrow we cannot have 2% drop. That is part of the game, because we have been sitting on 27, 28% move right now from the April lows. I would still call it, we are in a bull run, even if it drop 5% from here, because we have broken above all-time highs. We have already made new high. So a correction can happen anytime. But we are talking more from a medium term perspective. Like, I'm more bullish on that later this year, whether we will go higher up or versus going down from here. Whatever corrections happen in the middle, there's much more high probability that unless the yields start going up, or unless there is another macro event which can change the rules, at this moment it's looking like that all pointers are toward higher high in this year. So that's what charts are telling us. That's what the money supply and the yields are telling us. Now, we should keep watching, and that's why we do this weekly review, or maybe at least twice a month we are doing right now. The goal here is to keep looking at those parameters, look at whether anything changed. And what I can see right now, everything is changing in the favor of bull run. No, there is no warning signals in any of the data we are seeing. So that's all I can say. So again, I think we did just a quick reminder that we will be putting this in public domain. So if you want to ask a question, you don't have to say your name. You can put it in the comment section also. But yeah, I think if you are joining late, you can also see the recording of it later on as we post it on the group. So any other questions, we can take it. Otherwise, I think as we were discussing, it's a great Friday. Markets are making new highs, which is definitely, I think, what we were not expecting all-time highs, but we were expecting that we will continue doing better than what we saw as when we kept reminding you that April worst was behind us. I think now how high we go, I won't take a guess there, because markets has a way to surprise us. But I would say that right now we are seeing, means earnings. Okay, what are the new triggers? Let's have a quick discussion on what to watch out for beyond the data, which is basically looking behind, because data can change anytime. So what to predict now? So what you need to look for is, of course, there will be a news of whether the tax bill passes in Senate, whether they come to an agreement between Senate and House committees and so on. That is more or less priced in, I would say, but there will be some euphoria the day it passes. There will be some positive reaction. Whether it turns into sell the news, maybe. But I think that is not because there's anything negative coming. That is because markets are already betting on it, and there's always a profit taking. The second thing is we are very soon entering the earnings season in July, even though the major earnings will come 3 to 4 weeks later, so it's not immediate. But that's what market will start looking at, because already we are seeing people projecting what will happen in these earnings. Already people are, because towards the end of the quarter, most of the analysts, they already start putting their own numbers from their own channel checks and so on. So there will be this analysis start coming. So I think that can continue to keep the momentum in tech stocks. So that is one thing to watch out for. Means we always talk about the earning month is usually in a bull market, earning month is always going to be, either giving more momentum or means I don't see any reason why earnings will slow down or any other specific uh, negative news around that. And the third thing is, of course, the trade deals. And I think the concern a few people had, and we discussed in WhatsApp also, is the 8th July deadline where all the reciprocal tariffs supposedly are going to come back. That I'm not concerned because of two reasons. One is that already, I think last couple of days, I'm seeing these headlines that they are going to, make some deal with China. And they are moving very fast because China is the most important thing, like the biggest import and the most of the impact of almost every thing on the stock market is related to China. So if there is any positive news over next 1 week or so with the actual signed trade deal, that is going to be a good positive news. The second thing is that in a couple of interviews, Besant has already mentioned that even if the no trade deal is reached in with China, they might extend this exemption of tariffs. So they have no intention of bringing this tariff back to reciprocal level. And third thing is, as we saw, right, means even during the April, before the whole drama of tariffs, there was so much front running. And right now, when the tariffs are at a lower level, already with the exemptions, I'm sure the suppliers will take care of it. Like they're not going to take a risk of it July. So I think to real impact to happen for these tariffs, first of all, there has to be no trade deal. Second is they should actually start applying those higher tariffs immediately from July. And third is, uh, you know, we have to wait for all this front running to run out. So all these things are still like, not a huge negative for the market. And in the meantime, we will start seeing these earnings. I see a comment here about the Canada trade war. I think people have got bored of Trump's tweet now. Means he escalates from time to time. This is usually a negotiation tactics. Maybe some discussion did not go great, and he just decided to tweet. Market is not even caring about it, as you can see. So this is more or less, and plus the Canada is not a big factor in most of the market. Like they are not a huge negative trade partner for US where there can be any major issues. I think yes, there will be, as we said, right, market can use any reason to correct when you are already overbought in some conditions. Like some stocks are already overbought when we are already breaking all-time highs. So I would not give credit to any of these. Means market can use it to bring it down a little bit, but there is nothing changing fundamentally with any of these news. The only thing fundamentally in trade war what matters is China. And if China, something negative news flow comes that there is the whole discussion falling apart or some kind of no deal kind of indication, I would worry about those. Individual countries, I don't think most of them don't matter at this stage in the trade war. And that is because most of these countries have very limited impact or at a broader market level. Means yes, some industries, some stock. I'm not suggesting that individual stock level there can be bigger impact for sure, depending on what deals are announced and what means. Just like we saw for a short term, Nvidia got hit because of the China issues. We have seen Apple getting hit because of the tariffs. These are means very specific issues which are either getting resolved or they're already priced in. But other than that, at the major wider level, because almost everybody manufactures their goods in China, that is the only country which matters in terms of trade war and how worse it gets from here. So that is my take on any news flow around trade. Means I think people are not worried about Canada or even India or any other countries where the actual trade size is very limited. All right, so I think this is it from my end, and I think we are going to review again on, I think next week is a holiday week, so we will mostly not have this call. It's 4th of July. So have a great week, guys. And I think as we discussed, it's a question. The goal here is to always look at bigger picture. Means we are trying not to get swayed by day-to-day news. Let's not be euphoric. Means while market is euphoric, means we don't have to worry about it. we have to just look at whether these factors remain the same, whether we can continue this bull run. As we discussed today, that there are very good signs right now in the market. There is nothing stopping this run. But on the other hand, plan for medium to long term. That is always our guideline. Markets go up in long term. Markets have very good conditions at a macro level to go up later this year. It may happen in next 1 month itself. Means we are not ruling that out, because once the conditions are there, market can run up even now to much higher levels, or we may take a step back and go up later. But basic idea here is that the whole all the signals are showing us that we are in a pretty good kind of macro environment, and that is what matters, where you need to make a plan. You need to make a plan considering that what will happen in short term. You can have a quick drop, you should have a plan for it. This is exactly what we try to cover in, like, how do you deal in these kind of environments, using options, using a much medium to longer term approach. That is one thing which we always do at Proflex. So feel free to continue discussing that. We have some really amazing discussions happening on our macro, but also we had started this options group. Feel free to participate there and ask questions on how we build some of these strategies. I think we did have a good discussion yesterday about how we used our April dip, and there were some very good questions coming in there, that what if there is no capital to deploy in the dips. And we did talk about how you can increase the leverage, or how you can, in the current condition when some of the stocks have run up too much, how you can cover them in terms of hedge them by using covered calls. All these things will teach you why it's very critical. If you have a big portfolio size where you are able to trade 100 stocks at a time, you should join that group and learn a little bit around options, and we can continue the discussion there. So again, thanks for joining, and let's continue this discussion over the next few weeks in the macro group, and looking forward to talk to you in 2 weeks from now. Thank you.